Saurabh Mukherjea is now with us. Saurabh, thanks so much for taking out time for us. What do you make of this listless move that's happening in the market since the budget? We're trying to go up, then we come down. Overall, the breadth of the market is not good. There seems to be derating of a lot of sectors. What do you make of this overall view?
I mean, look, I have to confess, we don't lose too much sleep on market movements. We've seen this happen in our country today, that if you get lost in uh, uh, this quarter, what's happening last year, what's happening on liquidity flows, China recovery, the whole Adani piece, if you get lost in this sort of noise, you'll never make any sensible investments in your life. So we focus on what's happening in the broader economy. Are the companies that we are investing in, are the profits growing? Are we investing in the right companies and so on? And if I look at the economic picture, I see a pretty solid situation. Credit offtake continues to be robust, as everybody is seeing. Auto demand is strong. Credit card spending is strong. Spending on holidays, hotels, airlines is strong. The capital goods cycle is recovering. Even the Western recession, which was supposed to happen, is nowhere in sight. So I see a solid economic outlook. I see well-run companies across all our portfolios growing earnings at around 20 to 25%. And therefore, I'm not losing too much sleep about, where is the market before the budget, after the budget, and so on and so forth.
Just looking, Saurabh, hi, firstly, looking at the macro environment right now and particular indicators for India, do you sense that inflation could be abating and thereby the interest rate cycle anywhere close to a peak?
I think inflation is abating, but I think, like many other people, I've been surprised at how slowly it's abating. I think both in the Western Hemisphere and in India, the abatement of inflation is slower than expected. I think part of the reason for that is even now it's a full year post-COVID, even a year after COVID, demand actually continues to be pretty strong. So even though the fiscal boost that the Western governments have given has been removed, the monetary boost the Western governments and our RBI had given has been removed. Even after the removal of that, the demand environment actually is surprisingly robust, both in the West and in India. And that's what I think is holding up inflation at the 6.5% mark. I don't think the rate rise cycle has too much further to go. We're probably reasonably close to the top of that. But demand environment good, economy in solid position, India's macro fundamentals in decent shape. That's why I keep emphasizing to our clients that don't lose sleep. What's happening to stock prices and Nifty and the whole Adani business, don't lose sleep on that. Focus on the fact that you're living in an economic climate which is incredibly conducive for high quality investing.
Saurabh, hi. This is Anisha also joining in the conversation. You have been quite, bullish about the results that came out from the IT companies in the quarter gone by, and I understand you've added Tata Elxsi as well to one of your portfolios. Any other mid-cap IT names that's catching your attention this morning? Of course, there was that acquisition news in Sonata Software.
So look, our main player on IT is TCS. So in our consistent compounders portfolio, we hold TCS as one of our largest holdings. I'm an investor in consistent compounders, so are my parents and our 10,000 clients. In some of our advisory portfolios, we've also had Infosys for the last 6 months. We're very happy with both those positions. In our mid-cap portfolio, which is Rising Giants, we have LTTS, and as you rightly said, we recently added Tata Elxsi. These are plays on engineering R&D. As the West reindustrializes, and it's very, very clear, the hostility between the West and China is leading to a concerted move to reindustrialize the West, reshoring of the auto manufacturing, significant amount of chip manufacturing also, I think, will move out of China. We've kept discussing on your channel, API manufacturing will move out of China, partly to India, some of it to America. As the West reindustrializes, engineering R&D companies like LTTS and Tata Elxsi, we think will give us a straightforward ability to benefit from that. Both are proven players. Both have shown over the last 6 years steady growth in their top line, bottom line, 20-25% consistent growth in the business. The ongoing digitization of the world and the reindustrialization of the West, I think, are very exciting prospects for us as a country and for these two companies, LTTS and Tata Elxsi. More engineering R&D, these two are. This is less IT, more engineering. We're not big fans of mid-cap IT services stocks. We've always had a bit of a concern that mid-cap IT services stocks are more fragile than they look otherwise.
Saurabh, I'm also curious to know your rationale behind a couple of these names that you have in your portfolio, Divis Lab as well as Amrutanjan. Divis Lab has been disappointing and so has been the share performance, at least in the last 12 months. And there are these recent whistleblower complaints, etc., that's come out on Amrutanjan. What's your take there?
So let's start with Divis Labs. So we don't think Divis Labs earnings performance has at all been disappointing. They were obviously a big beneficiary of Molnupiravir and COVID. Merck gave them the entire Molnupiravir contract. And now that we are coming out of COVID, obviously the Molnupiravir revenues are not there. If you look at Divis now versus the fourth quarter of FY20, the last pre-COVID quarter, the business is 30% bigger. So they've grown, excluding COVID, they've grown the business by a third through the COVID years. Our reading is, and consistently talk to the world's largest pharma companies, the innovator company's consistent view is this is now the go-to company in the world amongst the world's top 5 API manufacturers. Divis is a top 5 API manufacturer globally, the only Indian company to be on that list. The consistent view from the global innovator pharma companies is this is our go-to firm for more API contracts and more custom synthesis contracts. So we've doubled the position in Divis Lab gradually over the last 12 months as the shares have halved. And we remain very optimistic that we'll make lots of money here. As I was just saying a few minutes back, if anybody watching this program loses too much sleep on short-term movements in share prices and earnings, it's very difficult to make lots of money in the Indian stock market. This is a classic example of that. 35-40% ROCE company consistently has built a powerhouse franchise at a global scale over the last 30 years, and we are happy to ramp up our position further if the shares come off further. On Amrutanjan, remember the whistleblower complaint has been investigated by management. So this is a company with very high cash conversion, so operating cash flows typically higher than operating profits. There's no debt on the balance sheet. This is a high margin company. If members of management, distinct from the promoter, members of management are doing anything naughty, I'm sure the Deloitte investigation will pick it up, and we as shareholders will be very happy because then the operating margins will go up further. This is already a very profitable company with 200, 300 crores of cash on the balance sheet. If somebody has been naughty in the management team and has done naughty stuff in terms of pilfering from the company, then we would, as shareholders, be delighted if those people are caught and the margins rise even further. So I'm not particularly perturbed about the whistleblower thing. I'm very happy with the management. The board has hired Deloitte to investigate the matter.
Saurabh, I mean, it doesn't come as a surprise to me, at least, as to why you would sell Relaxo. I mean, the numbers were disastrous this quarter. But does it intrigue you? Why? Because at the same time, the peers have delivered pretty well, your Metro, etc.
So even in Relaxo and generally in footwear, the middle class and upper middle class segment of the market, Aisha, is doing quite well. And it's understandable, right? The strata of economic society that your viewers belong to, that most of us in the city of Mumbai belong to. The affluent strata of society is doing well. So Relaxo's sandals business, their Sparks business is doing well. Right Metro shoes is doing well. Bata is doing well. The part of India which has been utterly pulverized over the last 3 years is the working class. Relaxo's 80, 100, 150 rupees segment is where they got founded. And we didn't sell the stock because they got founded in 80, 100, 150, right? We're quite happy to hold companies that go through these temporary blips in performance as a specific part of the economy turns south. In Relaxo's case, and in the case of many of the FMCG companies, the fact that working class people have been hammered has hit their numbers. What perturbed us was the fact that Relaxo doubled its prices for its entry-level chappals when crude prices rose. I've always held the view that the reason companies like Pidilite, Astral Poly, Asian Paints are such great long-term investments is because they use every rise in raw material prices to suffocate the competition, smash the competition. They refuse to hike prices. The competition gets wiped out, and the champion pulls away more market share. That recipe Relaxo deviated from somewhat, and that's what really got us a little worried. But the affluent part of Indian society generally is doing well, and therefore affluent part of Indian footwear market, whether it is Metro or Relaxo, continues to be in good shape.
Right. Saurabh, when we just talk about the things that you just mentioned about the consumer pack, you think a lot of other consumer companies, after the sort of correction we have seen, are looking interesting with the same theme that market share gains would happen, up trading would happen. Is that something which you would really look at going ahead? We spoke about footwear, but there could be various other names within different categories of consumption.
Yeah, I think again we come back to fundamentals, right? If a company says I'm waiting for a macro recovery and I'm going to the my religious place of worship and playing fervently for a macro recovery, a lot of companies do that. That doesn't cut too much ice with us. We need to see companies invest in the economy, invest in factories, invest in products, invest in growing the business. I'm not so sure how many of the FMCG companies do that in full earnest. They have very high ROCs, good for them. That means it's a very high surplus generation of capital. But they often tend to dividend out most of this money rather than reinvesting it into the Indian economy. So our main FMCG pick is Nestle. Our main FMCG play is Nestle, and one of the reasons we've been steadfast holders of Nestle over the last 5 years or so is the reinvestment ratio is very high for an MNC FMCG company. So they reinvest around half of their surplus capital, the other half gets dividended out, and that allows them to grow the business 10-11% volume growth steadily quarter after quarter, when the other FMCGs deliver, say, 3-4% volume growth. So if we can find consumer companies that are consistently reinvesting surplus capital to grow their growth, we'll be very happy to look at them. Amongst the non-FMCG players than consumer, Asian Paints, as we have said thousands of times, is a celebrated play on that, right? The $1 billion capex announcement, growing not just the paints business, but even the home decor business, is symptomatic of what makes for a champion franchise in India. Similarly, Pidilite, I think 3,000, 4,000 crore capex underway. That's what you need to see, not just a stable franchise, but high ROCEs being reinvested to grow the economy, grow the country, grow the market.
Right. The things that you mentioned are about companies that have tried and tested, proven themselves over years. How would you look at the consumption space of the newly listed space, the way they are growing, the way they are getting profit conscious? You think that's also a consumption play, or you would just wait for them to find their real valuation and then look at it?
I'm not so sure valuation is the primary concern. I think many of them don't yet have business models which are actually viable. So what do I mean by that? A company exists, any company, new age, old age, a company exists to generate surplus cash, right? But that's the whole purpose of corporate existence. You're not existing to sort of do a charitable endeavor. You want to sell something useful to the public and generate a surplus. I'm not so sure how many of the IPOs of the last 18 months are actually in a position where on a sustainable basis, they can actually generate surplus cash. And therefore, the least of my concerns is valuation. I think my deeper concern is, will we see a bunch of IPOs where more sensible business models go public? I think Nykaa is a sensible business model. I think Falguni has built a business which can in the long run generate lots of cash. We're looking at Nykaa, we're researching it for the past year. We're not there yet in terms of making an investment, but we need to see more Nykaa type new age companies and less of this pizza delivery nonsense that we see in our country.
Saurabh, I was looking at the portfolio, and one thing which is conspicuous, and correct me if I'm wrong, is that you have no exposure, no large exposure at least, to any of the auto names. Is that a conscious call?
Yeah, zero competitive advantage in Indian auto. We've got Eicher Motors, Royal Enfield specifically. We think Siddharth Lal and team over the last 15 years have built a business which has pricing power, strong competitive advantages, translating into high ROCEs. But rest of the Indian auto names really, very little pricing power, constantly having to snip away at prices, constantly get pounded by raw material prices going up. And I think the EV stories will also go a similar way. Until we get Indian auto companies that are able to build material competitive advantage by doing something very different to what the competitors does, having distinctive capabilities, it's difficult for us at Marcellus to invest significantly in the auto OEM space.
Okay. Saurabh, great to have you on the show as always. Thanks for taking time out.
Thank you. Thank you very much.